In this tutorial, I'll be going through with you MKTX stock. I'll copy that and paste that and click stock. And I can see from left hand side there's stock name MarketAxess Holdings Inc. And the right hand side information is from Wikipedia and left hand side is from Google. If I want to buy the stock right now, I have to pay 341.90 US dollars. That's the current price per stock. And when was it founded? I can see from Wikipedia in 2000. And if it doesn't show outside, I can just click in Wikipedia and there's a box inside and you can see founded 2000, industry is financial services, and the other information you can have a read. Now I just want to go to macro trend, which is a website I have left in the link description, and if you have any questions regarding anything I'm explaining, you can please ask. I'll be happy to answer. Just click on price ratios and price book ratio and search in the company you are trying to look ratios for, and it takes time to load. Okay, so book value is the real worth of the stock and stock price is the market price. If the book value is $1 and the stock price is $2, that means that you're paying $2 to buy something of $1, which is expensive. So price to book ratio means that if it's less than 1, that means that you're buying a stock that is undervalued or at a bargain. It's the ideal time to buy when it's less than 1. So you're buying it cheaper. If it's 1, that means it's not expensive or not cheap. So you're buying the real price. If it's more than 1, it means you're buying something that is expensive. So the higher the number goes, the more expensive it gets. So right now it's 20 times, it's 20.42, which means that it is 20 times more expensive to buy the stock right now. So you will be paying 20 times more money to buy this stock, which is very expensive. It has been cheapest in 2008, I think. I think so, 2008, June, when it was 1.04 times more expensive. So if you see vertically up, the real price or the book value was 6.28, but the stock market price was 6.52. So somebody who was buying in June 2008 was paying $6.52 to buy something that's 6.28. So they were paying a little bit more than what it really costed. But right now it's 20 times more expensive. So you need to be careful if you're buying this, even if the stock is doing really good, you need to be careful if it's very expensive to buy right now or not. So you might be paying a lot of money to buy right now, even though the stock is brilliant. But who wants to pay 20 times? So you need to be careful about that. So I'll go to other ratios and I'll click on current ratio. I'll go to other ratios, click on current ratio. Current ratio tells that if assets are more than liabilities. So if the ratio is less than 1, that means the stock is very risky. There's no margin of safety because liabilities are more than assets. If it's 1, that means assets are equal to liabilities. But we are looking at margin of safety. We want to buy when the stock is not risky, it's very safe. So we are looking at a ratio of 1.5 or more than that. So that's the ideal ratio we're looking at, because that means that the stock is very safe to buy. It's not risky. So it's just taking time to load. Okay, so you can see that the ratio is 10.82. It's way above 1.5, which is very brilliant. We are looking at 1.5 or more than that. So it's above that. Let's look at the previous trends and see if it has ever been below 1.5. So it has never been below since 2005, since we have the data. Up till now, it's more than 12 years. It's consistently above 1.5, which means it's very secure, it's not risky. Let's look at debt equity ratio. So, debt equity ratio means that if the firm is mainly operating on debt or equity, so it should be zero point 0.5 or less than that for it to have a good margin of safety, for it to be secure. Right now, it's 0.14, which means that although the company has taken debt, in 2019 March, it's still the ratio is zero point 0.5 or less than that. So it's less than zero point 0.5. So it's still there's a good margin of safety. It's still a secure stock, and the consistency has been really good since we have the data. So that's brilliant. Let's look at return on equity. We are looking at return on equity of 8% or more than that. So let's look the equity right now. So I'll just reload it again, and I'm just it's just reloading. Okay, so we are looking at 8% or more than that. Right now it's 29%, which is a lot more than 8%. Let's look at the back, the consistency of it. So since since I would say 2010 June up till now, it's like 9 years. It's consistently above 8%, which is brilliant. We are looking above 8%. But before that, it's less than 8%. So, but still, I would say since 2010 up till now, it's 9 years. Since 9 years, it's consistently, which is a long period to judge a firm. So it's consistently been above 8%, which is brilliant. Now, if I just want to see that if it pays any dividends, yes, it does pay dividends of 0.6%. Although the dividend is very small, but still it manages to pay dividends. If a firm is paying dividend, it means that they can generate enough money that after paying their creditors, their costs and everything, they're still able to they still have money left, extra money left that they pay as dividends. So they are financially doing very good. They have good dividends, and they have good they are making enough money that they have free money that they can give out to shareholders. So this is a very good sign for a firm. And you can see the market cap that it's a billion firm, and from Google. Then I want to know that what the employees working there think about it. I'll just check the reviews in Indeed, and I'll just click on it, and I can see that they have 9 reviews, which is not a lot of reviews to judge a firm. It's 3.1 star, but 9 reviews is not enough, I would say, if I want to judge some firm. So I'll have a look reviews in Glassdoor. Maybe they have more reviews. They have 50 reviews, which is quite a lot, more than Indeed, and it's 3.9, which is 4 stars, which is not bad, which is really good. 4 stars is really good, but there are 50 reviews, which is, I think, more. The more reviews you have, the better picture you get of the firm. And I want to see the salaries of the executives. I'll go to Yahoo Finance, I'll search in the firm, and make sure that the symbol matches. I'll go to profile. I will see that the sector is financial services, industry is capital markets. There are 476 full-time employees, and I can see the key executives here. There are 5 key executives, and all of them have the salaries shown. So which means it's very transparent. The more the information, the more transparency. All of them have salaries shown, which is brilliant. And I want to see that if they have any patents. So I'll go to Justia Patents. I've left the link in description, and I'll just type in, paste in this access, and I can see I'm just interested in assignee and applicant because these are people who have the full rights. I'm not interested in inventor because these are people who have invented but they don't have the full rights of the patents. So we have patents in 2010, 6 and 12 and 9. So you can just go through the list yourself and you can just see and make sure that they have recent patents like 15, 16, 17, 18 and 19, because sometimes the firm is innovating and they stop innovating after a while, and so they're no more like relevant, or they're not doing enough to innovate. They're not so the more they are innovating recently, they have recent patents, the more better, because it means that they are still trying to thrive in the competition, and patents act as a moat. So they have recent moats. It's not that they have very old moat, so which might not be relevant now. So it's very important that they have recent moats, recent patents, and you can just go through yourself. And then what else we have left?